Right friends, welcome back to Banking Awareness. This is 27th module. We are going to discuss some terminology not exactly related to banking, but it is very much essential. Difference between capital expenditure and revenue expenditure. What is meant by exchange rates, appreciation, depreciation, revaluation, devaluation? This assumed significance because in recent times we are hearing news items with regard to China's devaluation of its currency. What is the meaning of Memorandum of Understanding? Because nowadays several MOUs are signed, and what is the exact meaning of MOU? Whether it is legally enforceable or not? What are direct taxes, indirect taxes, and goods and services tax? We are going to look at these things in brief because in detail it may not be required for you. Look into the first one, capital expenditure. What is the meaning of capital expenditure? It is the expenditure to acquire or upgrade the assets. If some new national highway is constructed, that is capital expenditure. If some new airport is constructed, that is capital expenditure. If you are constructing new house, that is capital expenditure. But if you are whitewashing your old house, that is revenue expenditure. So the capital expenditure means basically for acquiring assets, long-term assets or equipment. If you look at the government level, government if it is constructing new national highways, new airports, if government is coming up with the new logistic parks, new shipyards, so this is all the expenditure, that is capital expenditure. And at the same time, please don't forget, for upgradation it is also called capital expenditure. If the capacity of Rourkela steel plant is expanded from 3 million tons per annum to 10 million tons per annum, that is also categorized as capital expenditure. If the capacity of any steel plant is expanded from certain level to certain level, that is also capital expenditure. So capital expenditure is for acquisition of new assets and upgrading the existing assets. Please don't forget. If you look at the revenue expenditure, this is the term to meet day-to-day operating expenses. You purchased a new car, that is capital expenditure. But you have gone for repairing that car. That car after some time developed problems and you are required to repair that car. That is revenue expenditure. You have purchased a new house. That is capital expenditure. You are undertaking repairs after 5 years. That is revenue expenditure. So revenue expenditure is basically for meeting the day-to-day operating costs of running a asset. And if you look at your personal level, purchasing a house is capital expenditure and making whitewashing to the house is revenue expenditure. Purchasing a car is capital expenditure and doing repairs is revenue expenditure. And if you look at the government level, constructing a new national highway is capital expenditure and doing repairs to the existing road is revenue expenditure. And purchasing new machinery is capital expenditure and doing repairs to the machines is revenue expenditure. As I have already told you, purchasing a new house is capital expenditure and doing whitewashing is revenue expenditure. So this is the way to look at the capital expenditure and revenue expenditure. I will tell one example from your perspective. You are doing a good job with the savings. You purchase some long-term asset, that is wise capital investment. Otherwise, if you are directly spending that money daily by having lunch in a 5-star hotel, that comes under revenue expenditure. So for any individual or for any country, there should be some capital expenditure. Otherwise, creation of long-term assets will not take place. If you are earning 50,000 rupees a month and if you are spending the total money for day-to-day expenses, then you may not be able to create any capital asset. That means a car, maybe house, maybe house site, maybe land. To acquire these assets, long-term assets, some saving is very much essential. So, day-to-day expenditure is revenue expenditure and long-term assets is capital expenditure, and for any government or for any individual, certain amount is to be kept aside for creation of assets, otherwise there will not be any growth, right? So, look into the next one, exchange rates. Always we talk about per dollar some 68 rupees. At present, we are recording this lecture in January 2016 and at present $1 is 68 rupees. This is the exchange rate between dollar and rupee. Why there is 68 rupees per $1? Why it is not the other way around, like 1 rupee is $68? That all depends on the dynamics of economy. From the beginning, our country is basically import dependent country. When a country is basically imports dependent, then the currency will depreciate in due course of time. Whatever the reason, I am not going into those details, but our currency value is $1 is 68 rupees. Why we are taking dollar as the benchmark is throughout the world, most of the trade it takes place with the dollar as the main currency, right? So, now it is 68 rupees per dollar, and if tomorrow it becomes rupees 100 per dollar, that is a depreciation. Today it is rupees 68, tomorrow if it becomes rupees 100 per $1, it is depreciation. That means our currency is depreciating. And if tomorrow the currency becomes rupees 40 per dollar, that is appreciation. That is strengthening of rupee. If it becomes 100, it is a downfall of rupee. The currency value is diminished. But if it goes to rupees 40 per dollar, that is the currency is strengthened against dollar. That is appreciation. This is depreciation. So the difference between appreciation and depreciation is the currency value will go up or go down. And this takes place because of market forces. If there is heavy demand for dollars, then automatically rupee value will depreciate. When there is excessive flow of dollars into the country, then rupee will appreciate. If rupee depreciates, what will happen? Our exports will be benefited. If the cost of this item in America is today $1, I will get 68 rupees. If tomorrow the currency depreciates to rupees 100, by selling this, I will get rupees 100. That's why exporters will be benefited if the currency depreciates. At the same time, if the currency depreciates, the foreign currency borrowers will be affected. The companies take foreign loans, those borrowers will be affected if the currency depreciates. If the currency appreciates, what will happen? Our exports will be affected. If the currency appreciates to rupees 40, then I will get only 40 rupees by selling this in America. At present, I am getting rupees 68, and tomorrow I will get only rupees 40 by selling this in America. So, currency depreciation will benefit exports, and currency appreciation will affect exports. Right? This is about depreciation and appreciation of currency that takes place only through the market mechanism that depends on the inflow of dollars and outflow of dollars. And please don't forget, most of the world trade takes place in dollars. Look at the next one, revaluation and devaluation. We have so far discussed about depreciation and appreciation, which is dependent on market forces. But if you look at the fixing the rate of currency by government itself, what China has done recently, China devalued the currency. If the government is interfering and government is fixing the value of currency, that is a devaluation or revaluation. Today it is rupees 68 and tomorrow government fixes it at rupees 100 per $1. That is the devaluation of currency by government. governments sometimes resort to devaluation so as to give impetus to exports. So, if government devalues its currency, the name given is devaluation. And if government increases the value of currency, or if government fixes at rupees 40 per each dollar, that is a revaluation. So, revaluation, devaluation is by the government, but appreciation, depreciation is the natural phenomena which takes place because of market forces. So, this difference please understand. So, with this it is very clear to you about appreciation, depreciation, revaluation and devaluation. Recently, China devalued the currency so as to give impetus to its exports. If every country devalues their currencies, then what will happen? There may be currency wars. Currency wars is the dangerous phenomena. If every country wants to devalue their currency so as to give impetus to exports, then it will lead to a peculiar situation. That's why the currency wars is the most dangerous phenomena, and we are not going into that detail at this juncture. Look into the next one, Memorandum of Understanding. Nowadays, we are getting several news items about Memorandum of Understanding. MOU, here and there you see, MOU was signed between X and Y. MOU was signed between India and Israel. What is this MOU? MOU is common intent of action. If I and my friend decide to go to movie in the evening, that is a memorandum of understanding between both of us. I am just telling it as an example. And it shows the intended common line of action. And both the parties informally came to the understanding to tread some path. Then it may lead to agreement in later stages. First step is memorandum of understanding. Next step is agreement. And MOU cannot be enforced legally. Then it is the first stage in the formation of formal contract, and it shares common intent. And nowadays, unfortunately, several memorandum of understandings are not leading to agreements. That is the unfortunate thing. But please remember, memorandum of understanding is some sort of gentleman's agreement. Taxation by the Government of India. We pay taxes to the Government of India because Government of India has to take care of us. Government of India has to build roads. Government of India has to make arrangements for common man to live. They have to go for dams. They have to go for irrigation facilities. They have to establish manufacturing industries. They have to establish airports. They have to establish schools. They have to establish hospitals. These are all being established by the taxes paid by us to the government. And there are two types of taxes, direct tax and indirect tax. This is under the purview of Ministry of Finance, Government of India. Now, let us look at direct taxes. Direct taxes means these are the taxes levied directly on the income or profits of person or firm. If I am earning 10 lakhs of rupees, I have to pay income tax. If I am earning rupees 1 lakh, I need not pay income tax. If Reliance Industries is earning rupees 1000 crores, they are required to pay income tax. So, it is the tax levied on the individual incomes or the firms. So, that means whoever is earning, they will pay. That is direct tax. Under these direct taxes and indirect taxes, I have taken only prominent taxes. And direct taxes, I have taken 4, that is personal income tax, corporation tax, gift tax, wealth tax, and remember wealth tax was abolished in 2015-16 budget. Personal income tax, this is levied on the personal income. If I am earning 1 crore rupees, I am required to pay this. So, personal income tax is levied on the income of persons. And this is progressive in nature. What is meant by progressive? Progressive means if I am earning 3 lakh rupees, I will pay 10% tax. If I am earning 6 lakh rupees, I will pay 20% tax. If I am earning 1 crore rupees, I have to pay 30% tax. That means if my income increases, I have to pay more tax to the government. That is progressive. right? So here personal income tax is levied on the individuals who are earning income. This is progressive in nature, and this tax is collected by Central Board of Direct Taxes under the Department of Revenue, Ministry of Finance. The second one is corporation tax. Here big companies are there. They are into lot of profits. They have to pay income tax on the profits. So the tax levied on big corporate firms like L&T, Reliance, BHEL, Infosys, that is corporation tax. And please don't forget, Government of India gets more revenue through corporation tax. And all the direct taxes are collected by Central Board of Direct Taxes. Then gift tax. If some X is giving gift to Y, lot of jewelry was given as gift by X to Y, then he has to pay tax. So this is gift tax, but there are several exemptions on gift tax. I am not going into those details. Look into the last one, wealth tax. Wealth tax is the tax on the wealth which does not generate income. If I have lot of jewelry in my house, that is not generating any income, but I have to pay some wealth tax on the jewelry. So that is wealth tax, but in the 2015-16 budget, this wealth tax was abolished. So all these are examples of direct taxes. The principle is whoever is earning money, they will pay. That is the principle of direct tax. Look at indirect tax. Indirect tax is the tax levied on goods or services. It is imposed uniformly on all the citizens. If some tax is imposed on Colgate toothpaste, if some tax is imposed on Pond's powder, that is to be paid uniformly. No exceptions, no poor, no rich, no differentiation. Whoever is purchasing that goods, whoever is accessing that service, if you are going to some star hotel and having dinner, then you have to pay service tax. And if you are traveling in train, you have to pay service tax. There is no difference between rich and poor. So this direct tax, indirect tax. Direct tax is on the persons or individuals, whoever are earning income, that may be person or firm, whatever it is. But indirect taxes like excise duty, then customs duty, service tax, these are levied uniformly, right? So this indirect tax is tax levied on goods or services. It is imposed uniformly on all the citizens, whoever purchase or use the service. Here central government imposes certain indirect taxes. Prominent among them are excise duty, customs duty, service tax. State governments also impose some taxes. They are value added tax, entry tax, octroi, luxury tax. So these are total put together indirect taxes. And for the taxes collected by central government, the organization responsible for it is Central Board of Excise and Customs. That is under the Department of Revenue, Ministry of Finance, Government of India. If you look at indirect taxes, excise duty. What is excise duty? When something is manufactured, if some toothpaste is manufactured, if some mobile phone is manufactured, if some Pond's powder is manufactured, on the manufactured goods, the companies pay excise duty to the government. So that is excise duty, indirect tax, because everyone has to pay the same price, whether Anil Ambani is purchasing Colgate toothpaste or a poor person in slum areas of Bombay is purchasing Colgate toothpaste. That is to be paid uniformly by all. That's why indirect taxes are uniform in nature. They do not differentiate between rich and poor. So excise duty is the duty on goods manufactured in our country. Customs duty, if we are importing something, on the imported goods, we levy certain duty, that is customs duty. And if gold is imported into the country, 10% duty is imposed. Like that, if some mobile phone like iPhone is imported into the country, certain customs duty they have to pay. And customs duty is sometimes imposed on exports also. I am not going into those details. Look at the third one, that is service tax. service tax is levied on the services availed. If you are going into some star hotel and takes lunch, then you have to pay service tax. If you are traveling by train from one place to other place, you have to pay service tax. So this service tax is paid on the services availed. Finally, let us look at goods and services tax. So far we have discussed central government imposes several taxes and state government imposes several taxes, and excise duty, service tax, state government VAT, value added tax, entry tax, octroi, luxury tax. So these are different types of taxes, and some of the states may have some other tax, and if the product manufactured in one state is going to other state, if one firm having manufacturing facility in one state wants to establish manufacturing base in other state, these interstate taxes are coming in the way, and so as to integrate all the taxes with the unified tax, that means all the indirect taxes, please don't forget, it will not look at direct taxes. Direct taxes is different. Direct taxes are paid by each individual or firm depending on the income, but indirect taxes are imposed uniformly. So far till date, central government collects some taxes, state governments collects some taxes, and state government's taxes are also not uniform across the country. So that is coming in the way of ease of doing business in the country. So as to improve ease of doing business, so as to improve the mechanism of doing business in the country, so as to eliminate different type of indirect taxes in this country, this unified tax, that is only one tax, is proposed to be brought under goods and services tax, which is popularly known as GST. This GST was struck up in Rajya Sabha. All of you are well aware, Congress is opposing and they want certain modifications. So this was struck up in Parliament. So this is about GST. So in this lecture, we have discussed several important aspects of appreciation, depreciation, revaluation, devaluation, direct taxes, indirect taxes, and goods and services tax. I hope you enjoyed this lecture. Please do join for module number 28. Right friends? Have a nice day. Thank you.